awesome gathering of Bitcoiners. I am delighted to be here in Nashville, a city known for music, a city known for freedom, and I'm honored to follow Senator Haggerty and address you today. Today, I've decided to use slides. And for those of you who've seen my presentation, some are with slides, some are without slides. I got a lot of good comments on the ones with slides, and so I figured the best way to make this presentation better was more slides. So number go up, and with no more delay, I want to talk about the Bitcoin revolution. And I also want to talk about rebuilding our global economy with digital capital. The world, as we know it, is based on 20th century ideas and 20th century technology. Stocks trade 9:30 to 4 unless there's a bank holiday. You can't do things on the weekend. Everything is slow. Everything is expensive. If we want to prosper in the 21st century, we need new ideas, and they need to be based on new technology. This chart you've seen before, I popped it up. It's $900 trillion of global wealth. It's that $900 trillion, it's spread across physical assets and financial assets that are 20th century ideas, 20th century technology. And in the upper left corner is a little orange blip, the little orange asset that could, what we call Bitcoin. It's $1 trillion. It seems like a lot if you started with zero, but when you look at it against the greater scheme of things in the world, it's 0.1%. Here's another way to see that same chart. It's not 900 trillion of assets. It's a bunch of assets held for their utility value and a bunch of assets held as a store of value, long-term capital. When I buy a house, I want to live in it. But when I buy a bunch of bonds, I just put my money there because I didn't know what else to do with the money. And when you start to see the world as a big chunk of long-term capital, $450 trillion or more of capital, and you start to think about the way we store that capital, you see the engine for the revolution. The global economy struggles because we're relying upon imperfect assets and imperfect systems to store that capital. It's crippling our capital preservation. So how do we engineer a better system? Well, this is Tesla, and Tesla had a quote. He said, "You want to understand the universe? Think in terms of energy, frequency, and vibration." I'm going to translate that. I'm going to talk about the physics of money now. What are the physics of money? Energy is money, or capital, or wealth. You could use them interchangeably for this speech. Frequency is about the duration or the lifespan. How long will it take? A minute, an hour, a year, a century? And we vibrate money every time we trade with each other, or we transfer from one locale to another, or we transform a property into another type of asset. And so here is an important equation. This is useful life is equal to the value of an asset divided by the cost to maintain that asset. If you're looking for the useful life of your money in an asset, then the way to figure it out is ask, how much does it cost every year to maintain that asset in pristine condition? What do I have to spend in order to avoid depreciation or decay? It turns out that useful life, is very close to something we know in the Bitcoin community as stock to flow. They're very related if you're measuring them in years. Many individuals and most corporations, they use financial assets to preserve capital. And this is the source of a challenge for us. Let's talk about financial assets. I want to keep my money for a long period of time. Start with $1 billion, put it in the peso, and the money is decaying in 2 years, right? A 98% inflation rate strips you of your economic energy or your capital. This is not a good long-duration asset. The Turkish lira, your capital lasts 3 years. The US dollar, under traditional monetary inflation for the past century, might last 14 years, but it's not like you have it for 14 years. The life is being sucked out of you linearly over the 14 years. Put your money in a hedge fund. What's the annual cost? It's 2% management fee and then 20% of the upside. About 4% a year if you're investing in normal assets. That means it's a 25-year asset. Treasuries, you're going to get a yield, but the 3.5% after-tax yield goes against the 7% monetary inflation. Maybe your money lasts 30 years. Capital in a mutual fund where you pay a 1% fee, 100 years. That's about the best you're going to get. If you manage to buy a diversified portfolio at 10 basis points, the counterparty risk is going to drive you to a 1% cost. So those are your financial assets. We're running the world on a 20th century set of ideas, and on average, the value of financial assets. But inflation is just the tip of the iceberg. You're also going to get diluted by tariffs and tolls and torts and transfers, taxes. We got all sorts of taxes, income tax, capital gains tax. Every time you vibrate and move the money, you get taxed on the money. And then if the taxes don't take you and the torts don't undo you, you've got weather and competition and obsolescence and politics, catastrophe. Those are the things that dilute the value of your capital over time. And if you want to maintain economic energy, you have to fight against that friction. Well, most people realize that's a frustrating endeavor and it's a no-win endeavor. So they give up on financial assets, and they start turning to physical assets to preserve capital. Well, here's a physical asset, a Ferrari. Not a good way to keep your money forever, though, because after 5 years, you've spent as much on the insurance and the upkeep and the depreciation as it's worth. Yachts aren't much better. If you spend 10% of your money operating it, you also get hit with depreciation. Don't store your money in yachts. A home in Miami Beach, if you buy a $10 million house, you better come up with $10 million to maintain the house over 17 years. Now you've got no money left. Silver, 22 years. A warehouse, 40 years, maybe 50 years. Bar of gold, 62 years. A painting, 72 years. Land, the average property tax in the United States is 1.1%. That means your money is going to last 91 years. Unless the government reassesses the value of your property, then it's going to last less than 91 years. The oldest family ranch in the United States is King Ranch. They made it 173 years. Every other family in the country failed. And here's the longest held property, the Crown Estate in the United Kingdom. You could say the royal family held it since 1066, but on the other hand, it passed from the Plantagenets to the Stuarts, through the Lancasters and the Yorks, and eventually found its way to the Hanover family. And so maybe 7 different families split that. None of them got to take it with them. So physical assets you might think might last 1,000 years. Probably about 50 to 75 years is the best you're going to do. Entropy is diluting the value of your physical assets. It's sucking the capital, the energy out of them. There's a reason it's called earth and not heaven. Because politicians are very creative. They got a city tax, a county tax, a state tax, a federal tax, a transfer tax, a usage tax on the property. And if that doesn't get you, there's rent control, price control, or a culture shock. Then you got competition. You might get discriminated against. There's recession. The currency can collapse. Your tenants won't pay you. Someone will slip and fall on the front sidewalk and sue you. There's weather, war, crime, and catastrophe. And if energy prices go through the roof, it's going to be hard for you to make a go of it. Physical capital is not a simple solution. Something I learned at MIT, the 3 laws of thermodynamics. You can't win. You can't break even. But you can't get out.